Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. With me today, sometimes the tongue just doesn't want to cooperate. With me today is Jeremy Rettich. He is with Virtue Capital over in Brentwood. I've known Jeremy and his whole family, for that matter, for probably about 20 plus years now. And one of the things, and Jeremy's been on the show many years ago in different format, back in the old studio and everything he's been on. And today we're getting, finding that we've been collaborating more and more of late. And I love some of the strategies that Jeremy brings to the table. We've talked about strategic, of course, which I've been a big proponent of. But at the same time, I also am a big believer in having hedging strategies that help during different market conditions. And this is one of those areas we're going to talk about investment strategies. As I said before the break, how they, like when we talked about 2000 through 2002, right? That bull market or the financial crisis back in 08. How might, and we've talked about the strategic part. Now let's compare that with how the tactical strategy would have helped you during bear markets, okay? So let's that next slide on the investment strategies: passive, strategic, active, tactical, and maybe even have a little time to get into that dynamic piece in as well. So Jeremy, on this, let's compare the two.
Yeah, so just let's talk about strategic for a minute. Strategic, also known as buy and hold, right, is when you are diversifying your portfolio through different assets, right? And you stay the course. It can change. You certainly rebalance. Many times it's monthly. More often it's quarterly. And there's very little change to the overall portfolio. You stay the course for typically for many, many years, which in the long game, that's fine. Dynamic, let's talk a little bit about dynamic. We'll compare the three. So dynamic is different than strategic. When you are invested, you certainly have different asset classes that you're invested in, just like strategic or buy and hold. The big difference in strategic and dynamic is dynamic, meaning that it has the ability to trigger risk on and off. So if you imagine that you were invested and you had 4 different buckets in that account, each with its own lever. And one of those levers may say, let's go defensive, meaning we sell 25% of your equities and we go into bonds or to cash or somewhere that is less risky than equities. The second trigger could happen depending on what's happening in the marketplace, and so on. So it's in tiers, or it's in tranches, if you will, that you go risk on or risk off. So unlike strategic, that's buy and hold and staying the course 100% of the time, you do, or you can go defensive, as we saw last year. And then lastly, tactical management is much quicker to go risk on and off. Unlike dynamic, that's in tiers or tranches or buckets, if you will, it can go 100% risk on, 100% risk off, literally in a matter of a day. And I think it's important for viewers to know that this isn't something that happens, at least with us, where we call and check with the investor. This is something that happens based on the methodology of the strategy, and we do it across the board, meaning it's not getting permission. We are making it happen. We're looking out for you and every other investor that is invested that way. And I think that's important, going back to making decisions based on emotion. This is mechanical and repeatable. And that, I think, is important.
Well, and as you said, it's not, and this is the thing, the goal here, if you're going to use a strategy like this, you're signing up for it up front. You're saying, this is what I want to happen. I want that tactical piece in there that is going to, because of my risk tolerance, because of my fears, I want that in there that when it meets that criteria, it's going to push me over into, let's say, all bonds as an example, or if I want that in-between strategies where I want to at least hedge some of that risk, 25%, 50%, whatever it is, and I want to move some of my equities over in such an event to protect principal. All right, that's a choice. We're going to show you the pros and cons of each one, show you over different market conditions how each have performed, and what you'll see is that in certain market conditions, one outperforms another. And what if you remember with modern portfolio theory, one of the concepts here is what we call negative correlation. We want asset categories like stocks and bonds, and again, I have to stress each time I say this just to be safe, okay? Having just any old bonds in there doesn't accomplish this. Okay, if you've got long-term bonds, you actually have more of a positive correlation to the market. So mortgage-backed securities is an example. If you have junk bonds, more of a positive correlation to the market. So it's going to increase volatility rather than reduce it. What we want are short and intermediate term investment-grade bonds that have that negative correlation. So when the market's up, they're typically, stocks being up, they're typically not going to keep up, though they'll do fine. Okay, but when stocks drop, we want those to hold some of that up so that we're not taking as big a hit. That's smoothing out volatility. This concept is very similar to that. We're looking at strategies that also work in different market conditions with this kind of negative correlation to how they perform. And then when we blend them together, we're going to get the desired result, which is that stable, more stable return, less volatility, and that's going to help us with regard to income from our portfolios. So this is something that is not, you could do a standalone on each one, but I think the blending is probably going to be one of the better choices. Of course, it depends on your individual situation, and again, to stress that you get to choose up front. So you choose up front, that way when the time comes, no one's trying to find you out on a beach somewhere, right? To say, hey, we need to do this now. It's already been decided, and it'll be taken care of. It basically is taken care of for you. It's on autopilot for you from that point. And your advisor is going to already have your permission to do what's in your best interest in those kind of situations. So, Jeremy, let's talk then about another. And this is something that will be very helpful. I talked about a comprehensive financial plan. So if you'd like, again, to call the office, take advantage of this planning, we're going to add something to that, this stress test report. So again, if you call the office at 615-376-5325. One of the things that a part of the investment analysis we do is what Jeremy calls a stress test report. And I'm going to let him talk about that and how you can get that done as well. So again, 615-376-5325. Call the office. We'll get your information. And again, if you want a full-blown comprehensive plan at no cost, this is a great way for us to get to know each other, see if we want to have an ongoing relationship, if you need or want an advisor to do the things that I do, then we'll give you an opportunity for that as well. If it's a good fit for both of us. I've been doing this 30 years, and I got to say, on my calendar, I'm looking forward to seeing the people that are coming in, doing reviews with my clients on a regular basis, and so I'm kind of interviewing you as you're interviewing me, because I want to look forward to seeing you again as well. So if you call the office 615-376-5325, we get your information, send you out a checklist to bring to your appointment with me, and we can talk to you about all kinds of, we'll be talking to you about all kinds of things. The investment analysis piece, tax planning, Social Security, Medicare, how to control, manage healthcare costs in retirement, all of that is part of the package. Or if you just want to do the investments, just make that clear, and we'll adjust it a little bit for you just to address that. We're still going to do some additional planning because it's important to do the comprehensive planning. It's like going in and getting checked. You're not feeling well, you need to go in and have an exam to get the right prescription or the right plan, treatment plan set up. Well, it's similar here. We really need to see the whole picture if we're going to advise you about your finances and about your investments, find out what your needed rate of return is to accomplish your goals, and then build an investment plan around that, minimizing risk being one of the key factors for us as well, of course. So again, 615-376-5325. And when you come in to see me, I'll also give you a free copy of my book, 7 Steps to Financial Freedom in Retirement. All right, Jeremy, let's talk about this stress test report. That's one of those little tongue twisters, isn't it?
It really is. And before I talk about the stress test, I just wanted to touch on something that may be important. And that is how we collectively manage money, right? At Virtue Capital Management, we have many money managers. So we're a manager of managers. So Jeremy's not sitting up at night and deciding if we should sell Coke or buy Pepsi or go risk on or go risk off. We're choosing and selecting, aligning third-party money managers to help us do that. And I say that to say that many of our managers manage billions and billions and billions of dollars. We only manage currently, I say only, around $730 million of assets. But just know we have a very broad platform for strategic, dynamic, and tactical. And I say that to get to the point about the stress test. And I ask folks all the time, would you like to have your portfolio stress test? And of course, 90% of the time, time or more often than that, they're not familiar with stress testing a portfolio, but they are familiar with having their heart stress test, right? And it's very similar in the aspect that we're going to look at your portfolio. We're going to put it under different stressful situations to see how it has reacted in the past and how it might react in the future. And many folks see and find out and are unaware. They'll come into the office and say, Jeremy, I'm conservative. But when we run the stress test, we find that they're actually invested more like a moderate or maybe even an aggressive investor, meaning they're taking on more risk than they even knew that they were, and that they really don't need that much risk in order to get the return that they need in retirement. So if you'd like to have your portfolio stress test to see how it would have done over different time frames, as well as to see how much risk you're taking on, as well as to see how it might look to incorporate dynamic and tactical investing into your portfolio, we can certainly do that. It's a great report. It's always eye-opening to see how much risk you're taking on and if you're taking on more than what you should be.
Excellent. So this is all available as well. All you need to do is be able to call the office, 615-376-5325. We're going to take a quick break. Be right back on the Retirement Report.